All right, everybody, we're right in the midst of earnings season, and this week I'm going to be going over a company that I have talked about quite a bit on the channel. I've talked about quite a bit on the TCI podcast, on our website, whether it be on normal blog posts or our premium subscribers, and that is BCE. I do believe that this is one of the worst managed companies on the index right now. I do believe a lot of this, $73, $74 down to $33 drawdown could have been prevented by some fairly basic management choices. Instead, it seems like they are making every single wrong decision right now, and ultimately it is deteriorating a lot of value for shareholders, because I know a lot of Canadian retirees own this stock. I know a lot of Canadian pension plans own this stock. I know a ton of income-focused ETFs own this stock, and it is getting absolutely obliterated right now. I mean, we're sitting at a 12% dividend yield. Now, I am not of the opinion that this is a dead company, dead in the water. I do believe there will be a time to actually buy this stock, but management does need to, in my opinion, make some pretty harsh changes to the way they operate, to their overall collective strategy moving forward. And in this video, I'm going to go over the earnings, I'm going to go over the guidance, I'm going to go over the issues, and I'm going to go over what I feel will actually end up improving this company's share price. And until they do that, I do believe that the company will likely remain at best case flat over the long run. But let's dive right into it. And as always, everybody, if you want 3 of my top options for 2025, I'm going to drop that in the description below. It's an absolutely free report, takes you no time to get, and it's going to give you some insight into some research that I did on some top opportunities in Canada for 2025. So let's dive right into BCE's fourth quarter. Now, the one thing that alarmed me immediately off the bat when I looked at this, so executing on key priorities in 2024. So they achieved all non-revenue and revised revenue guidance targets for 2024. The one thing that's alarming to me right here, and the one thing that is just, it's puzzling, is they hit their revised revenue guidance targets. I would hope that you're able to hit revised guidance targets. If you've revised them midway through the year, obviously you have some sort of idea, better idea of where your revenue will come in at. So hitting revised revenue guidance targets is really not all that good. I mean, obviously, if you were to revise those targets and miss them, that would be exceptionally worse. But ultimately, if you issue guidance at the start of the year and you have to revise that guidance throughout the year, it's really not all that much of an achievement if you hit it. And the fact that they have this at pretty much, the first page of their report is a little alarming. They have their highest annual adjusted EBITDA margin over the last 30 years, 43.4%. The difficulty here is adjusted EBITDA margins, they're adjusted. They can effectively kind of add or exclude things that make these numbers look better. Ultimately, the underlying operations of the company are not going all that well. When we come down to the actual results, we can look at total revenue of $6.4 billion. When we compare that to Q4 of 2023, 0.8% decline. When we look to full year, we're looking at a 1.1% decline. Product revenue fell 5.2%, service revenue 0.4%. So when we look to adjusted EBITDA, we're looking at 1.7%. Effectively, all that probably would have been generated through an expansion in EBITDA margins. Again, they're adjusted figures. When we look to adjusted earnings, they fell 5.3%. When we look to just actual earnings, we're looking at a decline in 83%. When we look to operating cash flows, they're down 12.1%. And when we look to free cash flow, they're down 8.1% to sit around $2.88 billion. And this is a company that pays a dividend in the range of around $3.7 billion. So when we go down to the media segment, they increased revenue by 1.1%, adjusted EBITDA by 8.8%. Crave is doing quite well, 3.64 million subscribers. That's up 18% year over year. However, the media segment of the business hasn't really been all that good. I mean, when we look to actual operating revenue for the media business, I'm going to exit out of this ARPU section for here. it's effectively flat. It has a compound annual growth rate of -1% over the last while, and for quite some time, this is actually why I've said that I prefer TELUS, and actually why I hold TELUS at this point in time on kind of a short to midterm hold. They have more aggressive growth verticals that are higher margin, faster growing, whereas BCE really relies a lot on that mobile, on that internet, and on this media division. And I mean, it hasn't really grown revenue. In fact, revenue has shrank on a compound annual growth basis since 2019. So ultimately, that is not something we want to see. When we come to their outlook, this is the one thing that is relatively, a pretty good insight as to the fact that nothing is going to be improving in 2025 for this company. And ultimately, if they're going to do anything to turn this around, it's going to be internally. And that is ultimately, spoiler alert, it is the cutting of the dividend. So when we look to overall revenue in 2025, they expect it to go up 1% or decline 3%. When we look to adjusted EBITDA, they're looking at a 2% decline to 2% growth. When we look to adjusted earnings, they're actually expecting a 13% decline on the low end and an 8% decline on the high end. So $3.04 is what they earned in 2024, and they're expected to earn $2.80 on the high end in 2025. The difficulty here again is the company pays effectively a $4 per share dividend. So the one thing about telecoms is earnings per share is not the best way to go about it. You're better off looking at free cash flow because, it excludes those non-cash items like depreciation, amortization, things like that. However, when we come to the free cash flow outlook, we're looking at free cash flows of $2.88 billion in 2024. That was an 8.1% decline, and they expect an 11 to 19% increase in 2025. That is, 3.2 to 3.45 billion. So they're going to primarily do this because of capital expenditures sitting at $3.4 billion, and that's around $500 million lower on a year-over-year basis. So effectively, the bulk of the free cash flow increase is from those lower capital expenditures. When we look to $2.88 billion in 2024, we go to $3.45 billion in 2025. Effectively, lower capex will increase free cash flow. There's really no other way this company can increase free cash flow because, as expected, as we come up here, revenues are expected to be effectively flat to even shrinking. But the only difficulty here is if we come to the company's key stats here, we can see they pay a $3.90 or they pay a 99-cent dividend on a quarterly basis. It works out to about $3.99 on a year. And if we go to their total shares outstanding of 912 million and we times that by 399, we're looking at dividends of around 3.69 billion on the common shares. So if we come back to that free cash flow generation of $3.45 billion, we're still sitting around $200 million in terms of total shortfalls in 2025 when it comes to the dividend. And that is at the absolute top end of the guidance. So even if things go absolutely correct for this company in 2025, unless they come in ahead of guidance. But the thing is I don't really expect them to. They've really struggled on this front. I would actually expect it to come in more on the lower end. And that is if they don't actually revise their guidance throughout the year. But even if they hit this top end guidance, we're coming in around $200 million short for the dividend. So effectively, they're going to need to come up with that money somewhere, whether it be debt issuances, whether it be equity issuances. And the difficulty here is they're going to need to come up with that free cash flow, that payment for the dividend somewhere. So they're either going to need to finance some of their capital expenditures via debt or via equity, which is probably expensive right now. The company's debt rating has been downgraded. Their equity, obviously, you don't want to be issuing equity at a more than 50% decline here. So effectively, that $200 million shortfall, regardless of where it comes from, it's going to be value deteriorating for shareholders, in my opinion. And ultimately, this company needs to cut the dividend. They need to just get it over with, cut the dividend. I mean, I remember I was kind of saying this, I believe it was even 10 months ago. It was almost a year ago. I made a video stating that BCE should be cutting the dividend because it will allow it to reshore its balance sheet. It will allow it to, allocate more of that cash flow towards debt. It will just put it in a better position overall. And a lot of the commentary I got was, if they cut the dividend, the stock price is going to tank. If we come to the 1-year returns here for BCE, the stock is down 34% over the last year. This is without cutting the dividend. I don't even think it would have fallen. I mean, obviously this is my opinion, but I don't think it would have fallen 34% if they just got it over with and cut the dividend. This is just kind of another situation where I think there's some very big missteps from management in terms of the overall management of the balance sheet of this company. And not only have they not cut the dividend, they've come out with a drip discount, like a dividend reinvestment discount. And ultimately, they're going to give people a 2% discount on BCE shares if you drip. But the issue is it's dilutive. They'll come from new shares, ultimately, which is just not what this company needs to do. If we look to the overall balance sheet, we're looking at total long-term debt of around $40 billion. If we look to the actual, debt increases, we're looking at 1 year. 1 year ago, they were at around 37 billion. Right now, they sit at 40 billion. If we look to 3 years, we're looking at 29.96 up to 40 billion. So they've increased their debt by about, let's say, 33% over the last 3 years. I mean, ultimately, this has not been the best time to issue debt. And the other massive misstep, in my opinion, for BCE was the sale of MLSE to Rogers. I'm not arguing against the fact that they maybe should have sold this asset because ultimately it didn't really generate all that much operating cash flow, but it was heavily valued because the sports teams are, pretty solid value. The difficulty here is the company went from stating that they were going to utilize that sale to pay down debt and then turn around, I believe, less than a month later and bought Ziply, which would be a US-based company at a historically weak Canadian dollar. They utilize all that MLSE's money to effectively buy a company in the United States, weak Canadian dollar, in a hyper-competitive market in an attempt to expand south of the border because of the potential headwinds when it comes to Canadian telecom companies. That being, we're talking about lower immigration policies. Obviously, these telecom companies, they rely a lot on immigration to fuel new customers. And one of the main reasons for this, and what I'll go over right now, is because of the declining ARPUs when it comes to their mobile segments. So ARPUs is the average revenue per user. So effectively, this is how much on average they generate per client that they have on their mobile plans. So if we look down here, we have a compound annual growth rate of negative 0.15%. So this company's ARPU since 2020 has been shrinking, and it's actually been shrinking drastically since 2023. Why? Well, first off, there's been huge competition in the space. The Canadian telecom sector, it is one of the easiest places for governments, for regulators to clamp down in terms of Canadians demanding cheaper cost of living. We're in a cost of living crisis right now, and the Canadian telecom companies are probably one of the easiest ways for Canadian governments to get Canadians cheaper prices. That is why these ARPUs are consistently declining even more rapidly in 2023 and 2024. These telecom companies are not going to get away with offering some of the most expensive phone plans in, I believe it's developed countries. Another added thing for this is if we look to bring your own device plans, they're accelerating in a big way because Canadians, they no longer have the money to, finish their 2-year contract, get rid of their phone, go on, buy a brand new phone, get onto a new contract. And when you have a BYOD plan, you have a lot more leverage from these telecom companies to get the best plans possible. So this is driving this down as well. So I believe BCE kind of made that acquisition in the United States in an attempt to kind of offset the declining ARPUs in Canada. They want to expand to a new market, which ultimately could work out for them, but it could turn into a complete disaster if they don't capture market share in the US, if they don't expand that business, because ultimately if you look to the long-term debt levels, if they were to have paid the debt off, that would probably provide them with a bit of relief in terms of financing costs. I mean, when we go to the overall financials for BCE, interest expenses are still a gigantic issue for this company. We look to total interest expenses. I'll X this ARPU off for a second. We're looking at, over the last, let's say, December 2021, when rates were low, we're talking about 1.08 billion. Fast forward, we're looking at, just shy of 1.7 billion over the course of 3 years. They do have a lot of debt that has to be refinanced over the next while here. They have, their debt ratings are getting downgraded, like I mentioned. Interest expenses have gone up around 14.5%, 15% over the last year, whereas we look to a company like, say, TELUS, they've only gone up around 7%. So there's still some interest expenses that are a main issue here. And if BCE would have taken that MLSE proceeds, which were around, I believe, $5 billion, just shy of $5 billion. I mean, that's more than a 10% debt reduction at this point in time. And I believe they actually took out more debt to fund this acquisition. So it's even bigger on that front. And I do believe that debt repayment would have provided stronger long-term shareholder value. Ultimately, this company is having to lay off employees, cut capital expenditures, do everything they can just to get back to even effectively. Like, there's not really all that much growth here overall. And I do believe, again, the main thing here that the company can do to just quickly get it over with and work on repairing that balance sheet is this dividend. It's yielding 12%. When a stock yields 12%, the market is pricing in the cutting of the dividend. We've seen, if we look to the dividend here, we can see that over the last 10 years, we're seeing relatively steady growth. But then here we can see the dividend start to slow, and then, I believe it was 2 or 3 quarters ago, they just slashed it, the dividend growth. They're not going to grow the dividend anymore. And then ultimately, what comes next for a company that simply cannot afford the dividend is it's a dividend cut. It just seems that management is really reluctant to do this. I don't really know why. I mean, I guess they have a reputation for being a very strong dividend payer, but ultimately the only reputation this company is going to have if they don't fix this issue quickly is just being one of the biggest destroyers of shareholder value in quite some time. I mean, this is a low beta blue chip Canadian company that has just been absolutely thrashed over the last while. And I know a lot of people may say this is possibly an industry related thing, but if you're doing that, you're probably just not paying attention. I mean, TELUS no doubt has had, a pretty rough go about it. It is certainly a dog, but we can see a clear deviance here. Where, TELUS over the last year is down around 3%, where BCE has lost around 28.5%. So this company is not doing a lot of things right at this point in time. Its 2025 guidance was really not all that appealing. It just needs to cut the dividend. It needs to get it over with. When we look to forward estimates, there's effectively no growth for this company on an annual basis. We're looking at $3 per share they earned last year. We're looking at, $2.75 expected in 2025. We're looking at $2.69 in 2026. And then we're looking at 2027, $2.86, which is still below their 2024 earnings. So analysts don't even expect this company to exceed its earnings last year for probably 3-4 years now. So, I mean, the number one lever they can pull right now is the cutting of that dividend. I do believe when this company cuts the dividend and starts to repair the balance sheet, get the debt in order, I do actually believe that this stock would have a chance to outperform the market because it does have high margins. I mean, it's a high margin business. It does generate a significant amount of cash flow, but the one thing that is putting a huge drag on the business is this $40 billion in debt and this, $4 a year, $3.7 billion dividend, when this free cash flow just does not line up with it and won't line up with it next year. For the purposes of BCE, I don't think I'm going to do any more videos on this company until they make some sort of fundamental shift. I figure I would make one last video so that investors can kind of get my thoughts on where the company's at right now, whether I'd buy it right now. I do believe that this is a company that does have potential, but management is just absolutely botching this, in my opinion. There's a lot of things the company could do that are non-operational related, like cutting of the dividend and allocating more to debt reduction. These are not things that require revenue growth. These are not things that require, an increase in customers. These are literally things they can do with a simple Band-Aid theory: cut the dividend, start repaying debt, start focusing more on repairing the balance sheet over attempting more aggressive growth acquisitions south of the border that, if they don't work out, could end up being a complete disaster. So everybody, if you liked the video, head down below, subscribe to the channel, like the video. Again, I've got that report in the description on 3 stocks that I really like in 2025. You can grab that absolutely free, and make sure to stay tuned for more great Canadian content.